Welcome to vTalkInsight Allocator's Lens Daily for December 23rd, 2025. Cross-asset signals are getting louder. Equities are still climbing on strong earnings and AI investment. Even as gold hits extremes, long-end yields threaten to reprice higher, and the next Federal Reserve chair remains uncertain. Let's start with equities and how this late cycle, growth-friendly backdrop is reshaping the risk and opportunity mix for portfolios. In equities, the dominant theme is a powerful but evolving risk-on backdrop. The S&P 500 has shaken off early December softness, logging several days of gains and extending what is on track to be an 8th consecutive monthly advance, with healthcare, financials, and materials now sharing leadership with the original AI winners. Strategists are talking openly about the S&P 500 potentially reaching around 7,700 by year-end, which would mark a fourth straight year of double-digit gains. Earnings expectations are central to that story, with forecasts for roughly 14% earnings per share growth next year and mid-single-digit to low double-digit total returns penciled in for the index. Compared with late last week, when the focus was already on strong earnings and an AI infrastructure boom, today's narrative reinforces that those anchors are still in place, but more widely distributed across sectors. Massive hyperscaler capital expenditure, estimated in the $300 to $400 billion per year range, is expected to sustain demand for semiconductors and digital infrastructure for years. AI leaders like NVIDIA, Broadcom, Oracle, and the large cloud platforms have either reported robust growth or raised guidance, feeding into upgrades to S&P 500 earnings estimates and a constructive outlook into 2026. Real non-financial corporate productivity growth of about 3.5% over the past year adds a macro foundation, suggesting that companies may be able to defend margins even as wage growth stays positive. Crucially, the market is no longer a single-factor bet on a handful of mega-cap AI stocks. Many of the early AI leaders are in correction territory, yet the broader indices keep printing new highs as sectors like healthcare, financials, and industrials take over as new leaders. Market breadth has improved meaningfully. Banks, retailers, transports, and industrials are all participating, and the Russell 2000 has outperformed large caps in most of the past several weeks, with small caps up about 15% year-to-date and positioned to benefit further if lower interest rates materialize in 2026. Internationally, developed markets such as France, Germany, and Japan are hitting all-time highs, and international equities have outperformed U.S. stocks by roughly 16 percentage points this year, hinting at a potential multi-year leadership shift. The other side of that upbeat story is valuation and quality. U.S. equities trade around 23 times forward earnings, close to 2 standard deviations above their long-run average, and price-to-earnings growth multiples for U.S. value and cyclical indices look elevated, implying that companies need to deliver exceptional earnings to justify today's prices. Under the surface, S&P 500 equal weight earnings growth is running at only about 4% year-on-year, underscoring how much of the profit acceleration is still concentrated in a narrower group of leaders. In small caps, a large share of recent gains has come from lower quality, non-earning companies, which makes the rally more vulnerable if financing conditions tighten or the growth outlook wobbles. Within technology and AI, dispersion is becoming more pronounced. Some semiconductor and optical names are up several 100%, raising concerns about stretch positioning, potential pricing pressure, and supply bottlenecks in the generative AI ecosystem. There are also signs of speculative behavior and complacency, with worries that leading chip stocks could struggle to keep up in 2026 even if the AI cycle itself remains healthy, and attention may rotate towards software, security, and infrastructure plays tied to AI adoption rather than pure hardware. At the same time, capital allocation is getting more selective, and first-mover advantages in hyperscale technology are expected to persist, meaning that not every AI aspirant will survive once the cycle matures. Equity volatility, meanwhile, remains subdued, with the VIX recently around the mid-teens despite the S&P 500's strong run and mounting macro uncertainty. Yet cross-asset signals point to a more asymmetric risk profile. Gold has surged roughly 70% year-to-date and sits at almost twice its long-term moving average, a rare occurrence historically associated with either significant corrections or regime change in risk assets. Some observers expect volatility to rise significantly in 2026, even if equities continue to perform, which would make the current low volatility backdrop feel more like a calm before a more two-way market. Against that context, the combination of strong earnings, ambitious equity return targets, and cross-asset hedging via gold suggests a late-cycle environment where upside remains plausible, but drawdown risks are also building. Looking ahead, the key equity questions for allocators revolve around where leadership settles and how much of the good news is already in the price. Materials are projected to deliver some of the strongest earnings growth in 2026. Transports like CSX and FedEx are showing sustained momentum, and large U.S. banks are seeing double-digit upward revisions to earnings estimates alongside higher expectations for capital return. Japan stands out with structurally improving wage growth, supportive fiscal policy in defense and semiconductors, and valuations still at a discount to U.S. and European peers, even after a strong run. Taken together, the equity complex still leans constructive, but with growing emphasis on selectivity, sector rotation, and sensitivity to any renewed shock in long-end yields or policy. Turning to rates, the picture is defined by a tension between an underlying easing bias and persistent upward pressure on long-term yields. Markets are watching the Federal Reserve Chair selection closely, with volatility in prediction markets reflecting uncertainty over candidates' policy leanings and, importantly, perceived independence from the White House. There has been organized pushback on some potential nominees seen as too close to the administration, while others, such as more dovish-leaning candidates, are viewed as aligning with preferences for lower rates. At the same time, investors recognize that the chair alone cannot deliver cuts without committee support, especially when recent inflation data are being treated with caution because of collection issues during the government shutdown and falling survey response rates since the pandemic. Against that noisy backdrop, the central message from policymakers is one of patience. The Federal Reserve is broadly expected to keep policy rates on hold for several quarters, waiting for clearer evidence that inflation is durably moving back to target or that the labor market is weakening more materially. Some officials continue to see room for further reductions in policy rates, but with the pace likely slowing from 50 to 25 basis point moves as rates approach a more neutral level. Key inflation drivers like shelter, labor, and energy are currently showing subdued pressure, which supports a benign inflation outlook and reduces the urgency for additional tightening, even as questions about measurement accuracy delay a definitive pivot. However, global forces are leaning the other way for bond markets. Major central banks are converging toward neutral, with the European Central Bank already there, while the Federal Reserve and Bank of England are expected to cut further over time, and the Bank of Japan is likely to keep nudging rates higher. Japanese 10-year government bond yields have moved above 2% for the first time since the late 1990s, amid speculation that persistent yen weakness could force more aggressive tightening. Coupled with fiscal strains in France and hawkish tones from the UK and Germany, this has pushed global yields higher, particularly at the long end, even as markets still anticipate eventual Fed cuts. In the U.S., the long end is central to the story. The 30-year yield is being watched for a potential move back toward 5%, a level that would have implications for mortgage rates, housing, and equity valuations, and could reverberate through global asset prices into 2026. The yield curve has already begun to steepen, with 10-year yields holding above 4%, and a twist scenario expected where front-end yields fall on policy, easing while long-end yields stay elevated or even rise, reflecting term premia, heavy treasury supply, and concerns around an unsustainable fiscal trajectory with debt around $38 trillion. For allocators, that suggests a world where cash and front-end bonds are anchored by a cautious Fed, but duration risk at the long end remains very much alive. Credit markets sit uneasily between the equity optimism and the rate market's warning signs. Traditional credit spreads are tight, offering limited compensation for default and downgrade risk, and scenario analysis suggests that in a recessionary shock spreads could widen sharply, translating into meaningful mark-to-market losses for credit investors. This is particularly relevant when both stocks and bonds are viewed as expensive on historical measures, which compresses the diversification benefit of a classic 60-40 portfolio and raises the bar for taking additional spread risk purely for carry. At the same time, private credit continues to capture attention. Semi-liquid private credit funds dominate new launches, with income generation and quicker capital return features appealing to investors looking beyond public markets. Yet actual flows into listed private credit vehicles remain modest. One flagship private credit exchange-traded fund has gathered only a tiny fraction of overall ETF inflows, suggesting that many allocators are still cautious about liquidity, transparency, or late-cycle timing. The result is a market where credit risk is increasingly migrating off traditional balance sheets into less transparent vehicles, just as macro uncertainty around growth, inflation, and policy is rising. Large U.S. banks complicate the picture by looking fundamentally robust. Earnings estimate revisions for the biggest banks are up by more than 15% year-on-year, roughly double the pace of smaller institutions, and expectations for capital return have risen by about 30%, with significant excess capital not yet fully reflected in consensus models. That strength provides some cushion for the financial system, but also means banks have capacity to extend credit or take risk at a point when spreads are thin and private credit structures are proliferating. For credit allocators, the soft landing base case still implies carry can be harvested, but the asymmetry if the cycle turns down remains notable. In foreign exchange, policy divergence and commodity dynamics are key drivers. Despite earlier narratives about an imminent period of dollar weakness, the U.S. dollar now looks more resilient versus the euro and yen, in part because markets see limited scope for further European Central Bank tightening and remain skeptical that the Bank of Japan will act forcefully enough to reverse yen weakness. By contrast, the Australian dollar is positioned to benefit from stronger commodities, with record highs in copper and other industrial metals providing a supportive backdrop for a currency closely tied to the global materials cycle. That sets up a nuanced FX landscape where relative growth in terms of trade may matter as much as interest rate differentials. The yen is at the center of attention. Persistent yen weakness has diverged from what real interest rate differentials alone would imply, reflecting a risk premium as markets doubt that the Bank of Japan will tighten quickly enough to stabilize the currency. Japanese authorities have warned about the pace of depreciation, and speculation is building that ongoing currency stress could force a faster policy response. Japanese government bonds have sold off as these expectations build, and rising domestic yields are feeding back into global rate markets, adding another layer of complexity for cross-border allocators. Crypto markets add a different but related dimension to the FX story. A clear divergence has emerged between faster trading-oriented participants who have scaled back exposure amid macro uncertainty, and longer-horizon institutional investors who continue to support structural growth and regulatory progress in the sector. In practice, Bitcoin and major altcoins are under pressure. Bitcoin is down about 30% from its October peak. Flows into spot Bitcoin exchange-traded funds remain subdued, and options positioning has shifted toward downside protection rather than upside speculation. That pattern reinforces the idea of crypto behaving like a high-beta, liquidity-sensitive currency proxy that is currently reflecting a more cautious risk appetite. Commodities round out the cross-asset picture, with a striking divergence between precious metals, industrial metals, and energy. Gold, silver, and copper are all printing new highs, but gold is the standout. Prices have risen by roughly 2/3 this year, with the metal now trading at nearly double its 60-month moving average. This strength is tied to expectations of lower U.S. interest rates, a softer dollar over time, persistent inflation slightly above target, and robust central bank demand amid geopolitical tension and waning trust in fiat regimes. Some forecasts even point to gold reaching around $4,400 in early 2026 and continuing to appreciate into 2028, though history also shows that moves of this magnitude often precede periods of heightened volatility or correction. The behavior of gold carries important cross-asset information. Unprecedented strength in the metal alongside still low equity volatility suggests a potential regime shift, where investors are willing to pay up for insurance even as stock indices remain calm. That combination raises the possibility of higher equity volatility and a more challenging backdrop for the S&P 500 over the coming year, even if a severe downturn is avoided. At the micro level, low-cost, politically stable producers, such as leading North American miners, are being highlighted as relative beneficiaries of the current environment, reinforcing the sense that capital is gravitating toward perceived quality within the gold complex. Industrial metals tell a more growth-oriented story. Copper markets are extremely tight, with major producers cutting processing fees to zero, signaling a structural deficit that supports a constructive price outlook. Fresh record highs in copper are underpinned by electrification trends, surging data center and AI-related power demand, and broader infrastructure investment, while recent breakouts in metals like copper and aluminum, alongside strength in related equities, point to a broad-based upswing in global industrial activity. That aligns with the narrative of a soft landing and suggests that, even as gold hedges macro risk, the real economy is still driving significant demand for physical assets. Energy markets, by contrast, are acting as a moderating force on inflation. The U.S. has intensified sanctions and even naval enforcement against Venezuelan oil exports, cutting shipments to around 500,000 barrels per day, less than 1% of global supply, and causing crude to accumulate in storage. These actions have added a modest risk premium to oil and gold, with oil prices ticking up around 1% on headline risk, but the broader crude market remains well supplied. OPEC Plus and U.S. production growth, combined with diversified buying from countries like China, are expected to keep downward pressure on prices into 2026, leaving oil as a source of ongoing disinflation, even as metals help to put a floor under longer-term inflation expectations. Stepping back, the cross-asset picture is one of late-cycle resilience with rising fault lines. Equities are buoyed by strong earnings, AI-driven investment, and healthier breadth across sectors and regions. But U.S. valuations are rich, and leadership in semiconductors and small caps looks more fragile. Rates markets show the Fed that wants to be patient, yet long-end yields face persistent upward pressure from fiscal dynamics and foreign central bank shifts, setting the stage for a steeper curve and more volatile duration risk. Credit spreads remain tight as private markets expand, while FX and crypto express policy divergence and a more cautious tone on liquidity-sensitive assets. Commodities add the final nuance. Oversupplied oil supports disinflation, but record gold and copper prices highlight demand for hedges and for real assets tied to the energy transition. For allocators, the key watch points are upcoming inflation prints, the Fed chair decision, long-end yield behavior, yen policy shifts, and whether gold's surge proves a durable new regime or a warning of volatility ahead. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.